Do you want to know if you're equity rich? 43.3% of homeowners are equity rich, meaning the mortgage balance is 50% or less based on the market value of the home. A lot of homeowners are sitting on so much equity right now, and they have no idea how many options are available to them. Refinancing is not about just lowering your interest rate. Hey guys, I'm Nikki Rogers with Team Nikki Rogers, located here in New Bern, North Carolina, serving locally in Eastern North Carolina. Also licensed in Virginia, North Carolina, South Carolina, and Georgia. We'd love to help you get home in all of those locations. 43.3% of homeowners in America have greater than 50% equity in their homes. That tells me that a lot of folks are not utilizing the equity that they have in their home to their financial benefit. What they're worried about is, can I lower the rate? But there's so much more to it than just the rate, and we're going to break that down for you. So today, in this video, we're going to talk about three things. Number one, when does it make sense to refinance? Number two, what can you use the money for? And number three, how to know if it could benefit you financially. In plain terms, a refinance is very simple. It is the restructuring of your debt. The number one misconception I think about refinancing is that folks usually think that you're changing just the mortgage that you currently have. It's an erase and replace. When you refinance your home, you're getting an entirely new mortgage. So when you're getting that new mortgage, one of the things you're paying off with that is the current mortgage and any other liens on the property. However, once we pay that mortgage off, we may have some more equity that you can then cash out of your property. It's less about getting a low rate and more about making your mortgage work for you in your financial situation. The two top reasons for people refinancing currently today is consolidating debt, number one, and two is actually uncoupling. First, we're going to talk about debt consolidation. When is that best for you? I would give a great example is that you've owned your home for 5 years, the equity position has grown substantially, but at that same time, you've had a child or you've incurred other debts, you've gotten a new car payment. We all know what those car payments look like today. So what we're helping folks do is take their credit card debt, their car payment, unsecured loans, anything that they currently have as a debt that is just draining them monthly and consolidating it into one mortgage payment with a lower interest rate overall, right? Because you got to think about that. Even if you have this great rate on your first mortgage that you got when you purchased the home, I can guarantee it meets nowhere near with the credit card and the car payment and the unsecured loans and that tractor loan and that Husqvarna and Lowe's and everything else that you've acquired since you've purchased the house. So what that does is lower your overall rate debt picture, consolidates it in one payment, and also lowering your output monthly. So you're probably wondering, what happens to the debts? Who pays them? How does this work? On the day we close, you're going to sit down with an attorney and they're going to do your closing refinance. They're going to give you one loan, and then they're going to take that loan and use the proceeds from the loan to pay off the first mortgage that you already have. And then they are also going to send checks to pay off the car payment and the credit cards and the unsecured loan that you may have. Not only is your mortgage a clean slate, so are all the other debts that we've paid off. So there you are in a position with one payment to worry about, one interest rate to worry about, and also freeing up monthly residual income that you keep in the household or choose to pay extra on your mortgage payment. One of the biggest benefits at the end of the day is that it helps you and allows you to pay off debt quicker, faster, and not pay as much interest to the banks. Are you one of those 43.3% of American homeowners that are equity rich but drowning in consumer debt? Then we need to talk, because what I just described is probably what's best for you and your family. The other way that I see people use the equity in their home for cash out refinance is when they want to make improvements. We see this with clients that are specifically move-up buyers that have been trying to find their next home and they just can't find exactly what they're looking for. They don't have to move, but they want to move because they're looking for something different in their home. Examples: a nicer backyard, getting a new pool. Instead of using the finance company that the pool company wants you to use for that higher interest rate, you can use the equity in your home and have one payment for the house that you're investing in. Another example is remodeling a kitchen or updating the master bathroom, adding a Carolina room. There's many things that you can use your equity for, invest right back into your own property. A third thing I'm seeing a lot, they know their home needs repairs. They can't afford to just out of pocket pay $20,000 for a crawl space repair, or maybe they need a new roof. It's not just improvements to the home. You can also use that for any repairs that you know that you need. By refinancing, you could potentially remove your private mortgage insurance or the mortgage insurance premium, depending on what type of loan type you have. If you have an equity position that is greater than 20%, you will want to refinance for the sole purpose of dropping that mortgage insurance premium that will then drop that on your payment. Therefore, we're leaving you financially monthly. Again, sometimes dropping the rate isn't the only option to get a lower payment, because folks forget that mortgage insurance premium that they were required to have when they were first-time home buyers is really just a sunk cost. So this is why staying connected to your lender that knows you personally, understands your financial needs, is super important, because we want to make sure that we're here through the entire process, utilizing the equity for your financial future. One of the other things that we're seeing a lot of is what I would call decoupling. That can be from a marriage that is separating. It could be a loss of a spouse. It could be when you bought your first house, your mom, father, grandmother co-signed on that, and you're now at a position that you can financially afford that home on your own. So taking someone off the deed or the title, we can do with any type of refinance. Also, if you have that extra equity position at the time of taking other folks off of the title and refinancing into your own name, you can still cash up to 80% of that value. An example where that would be important is the decoupling of a marriage. Typically speaking, one spouse wants to keep the home and they need to pay the other spouse their portion of the equity at the time of separation. So what this does for you is when we get the appraisal, we're doing all the work up front for you. And we can assist both parties with getting through this process confidentially, privately, and comfortable. If you're equity rich, want to know if you're equity rich, have any situation that you think that refinancing can support you, or maybe you don't know what you can do with it, please reach out to us. We'd love to give you a financial analysis. Look at your current mortgage versus your current debts. Look at your financial situation. Look at what life changes may be coming, or you want to set yourself up for success through all the stages of your life financially. I'm Nikki Rogers with Team Nikki Rogers. Please reach out to us. DM us, text us on the team line, email, Facebook, smoke signals. We're here to help you. Any question you have, we want to know and we want to answer it for you.